Welcome to the Buffered ETF, guys. Bear markets happen, but so do bull markets, so why not be prepared for both? Buffered funds offer some downside protection and some upside growth potential. They're like ETFs with airbags so that you can get retired, stay retired, and stop stressing over the next market crash. All content is for information purposes only and should not be relied upon as individual advice. Investing always involves risk and possible loss of capital. All opinions expressed herein are solely the opinions of the person making them. Participants and clients of ATX Financial Planning and guests of this podcast may maintain positions in the securities discussed in this podcast. Talk to your advisor before acting on anything. Nothing mentioned on this podcast, including specific investments mentioned, should be taken as a recommendation. Advisory services are offered through ATX Financial Planning, LLC, an SEC-registered investment advisor. Welcome back. How are you?
Good, Mike. How you doing?
I'm doing great. Are you great?
I'm great.
All right. You ready for the weekend?
Always ready for the weekend.
Big plans?
No, that's what's so great about it.
We're going to take one of my daughters to camp this weekend. Should be fun. It's her first overnight camp.
Yeah.
Got another son up in Canada at a Young Life camp. I'm jealous. I've never even been to Canada. Have you been to Canada?
That is one country I've not been to.
We should go.
There's a lot of country I haven't been to, but I've not been to Canada.
We should go up there and host a podcast.
Yeah, that'd be great.
Deal. All right. All right. So some people may say buffered ETFs sound too good to be true. We're going to talk about some of the things that are some positives about buffered ETFs. This is from Innovator. Innovator is a company who offers a lot of buffered ETFs. They're one of the pioneers in the field, and we have no affiliation with them, but I like some of their material, and we'll be talking about some of their buffered ETFs over time, maybe even today. But I'm going to read these off. There's 9 of them right here. There could be more, there could be less. This doesn't apply to every single buffer ETF, but I'm just going to talk about what this is and what they call the benefits of delivering defined outcomes in an ETF wrapper. And again, this doesn't apply to every single ETF, buffer ETF. Anything we say on here is not specific to any buffered ETF. It's not a recommendation. But without further ado, we do have to have our disclaimers. So here we go. Alan, you want to start reading those off?
Sure. Defined, do you want to list them off, then we'll discuss them later?
Sure.
All right. So defined return and risk parameters, cost efficient, no credit risk, point to point, transparent, no commission load, easily accessed and liquid, ability to manage, tax efficiency.
Let's hit them one by one. So defined return and risk parameters. Walk through that.
Most buffered ETFs, there's a segment, I should say.
You can say many.
Many. Yeah, how about many? That when you buy them, you know the time frame. They list out, here's the time frame that they're for. It could be 12 months. It could be 12 months. It could be 3 months, 2 years. So they're, for that time period, here's what you can expect for an upside cap. Here's what you can expect for a downside risk protection.
The buffer.
Okay. And so going into it, it helps you make decisions on which ones fit you best because it's very well defined.
Let's compare that to, I'm making this up. Hopefully there's not an ABC ETF, but maybe there is. But ABC 123 ETF, a typical one that has all the risk and all the return potential, right? So you could lose 100% or you could make 50% or 100% or 1,000% or whatever, right?
Correct.
But these, they kind of squeeze that risk return to some degree. Maybe they focus more on the upside. They give you a little more upside than a different competitor or peer or offering from the company with a little more or less downside, but you know what you're getting.
Correct. So you can go into it and maybe you're buying more than one of these into your portfolio. You know what I can expect from this one. I know what I can expect from this buffered ETF, which you're right, is much different than most other investments, especially around stock investments. It could go a long ways either way.
Do I have latitude to create my own ETF while we're on this podcast?
You always have.
So can I create an ETF or can I find one that gives me 100% of the upside with 0% of the downside?
That's what everybody's looking for. That would be
so we can't create that?
It just doesn't exist.
I don't know how to make it either. I've tried.
Would that be great, wouldn't it?
It would be great. And everybody wants lots of upside with no downside. But traditional equity investments are lots of potential upside, but with 100% potential risk or extreme downside potentially.
So I think it gets down to understanding of what drives returns. If there was no risk, there would be no risk actually produces a return, but that's for a finance class another day.
Yeah.
Okay.
And even bonds. I mean, some bonds, if you hold them through the duration, assuming no default, you have that defined outcome, right? If you bought, I'm making this up, $100,000 in bond ABC, and you held it to the end of the period and they didn't default and were able to pay the whole thing, then you get your money back plus your coupon interest rate that was along the way. But you still could look at your statement during that period and have perhaps more volatility than that. Some people may have expected when they bought into that bond because of the bids and the different interest rates and environment, right?
But you also said another key word, key term, or whatever phrase. You said assuming no default risk.
Oh,
right. So there's credit risk, unless in our circles, what you consider the risk-free rate is a U.S. Treasury, which is as close to risk-free.
And a couple of credit agencies have actually downgraded the U.S. credit,
right,
essentially this year or recently.
Yes.
So they're not immune to that. And so you've got defined return and risk parameters. And some people like that going in. Now, some people don't. Some people want all the unlimited upside and they don't care about this. So they're just going to gloss over this or go past it or even say it sucks. And they're welcome to their opinion, right?
That's right.
I've seen investments before that I like and some that I don't. Anybody's welcome to look at these and like them or not like them. But we're going to talk about number 2. So cost efficient. So what does that mean?
So if you asked, well, can I go create my own ETF to do such and such? I mean, technically, if somebody wanted to go out and buy the options, sell the options, and create these upside and downsides, people could do it. But it takes a lot of time, which time is money.
That's good. Opportunity costs.
Opportunity costs. And you may not have the expertise. So you may get better at it through time because you learn and become an expert, but there's a lot of cost there to do it. We have these ETF companies that have expertise. The reason they are able to get into it, there's different levels of expertise, but for the most part, there's a high level of expertise in this space, high volume, and they're able to do it pretty efficiently to be able to offer these. There are fees, but the expense on that is,
what they term is cost efficient.
Yes.
Right. It's not no cost, cost efficient. And everybody looks at cost different. Some people may think 1 basis point, 0.01% is too expensive. Others may look at something and say 0.5% is too expensive or 2%. And other people may look at something and say, hey, I'm okay paying a 2% fee and a 20% performance fee, as is the case in many hedge funds or private equity funds out there. So cost is relative. We understand that. And like Dallan said, with cost efficiency, if someone wanted to go and replicate these strategies, number one, most people don't have that expertise. Number two, to replicate a strategy like this may cost more money because when you do it in bulk, you tend to have these economies of scale for buying and selling and working with the different wirehouses and the different exchanges, et cetera, to do this. And if someone wanted to do that on their own, chances are they're not going to be greatly cost efficient. Now, there's probably someone out there who's just a miracle worker and they can do it great and they can do it. But by and large, I think that these companies make it very cost efficient relative to the expertise, the time, the money, and the time, because time is an opportunity cost.
Yeah. And I think we've discussed before that a lot of the benefits that we get from a buffered ETF, the main place that you could access that type of investment was through an annuity. When you go back through the history of annuities, those are usually more expensive or have been, historically more expensive than the fees that they charge.
I don't know ETFs. About that, but we can actually look at that. And there's a lot of different types of annuities. This is not a show on annuities, but you will find some commonalities between buffered ETFs and annuities, and you'll find some big differences between buffered ETFs and annuities. Some annuities have no fees. Some annuities have high fees or anywhere in between. So we want to be careful kind of looking at that. But it is a great point that you brought up on annuities because some people will think annuities are real expensive. Some are, some aren't. This isn't a show that we're going to go deep on that. But specific to this ETF, they tend to be and often are advertised as cost efficient. Now, if you go out and buy one of these, you can decide for yourself if that's cost efficient, right? Because again, a lot of these that I've seen and use tend to be in the range of 0.6%, 0.7%, 0.8%, 0.9%, something like that, 60 to 70 to 80 basis points to 90 basis points, something like that. And really even to tighten that range, I've seen a lot of them in kind of that 60 to 85 basis point range, which is maybe not cost efficient relative to what someone may think of maybe some other fund families where they're at 0.02% or 0.05%. But for the value that you're getting, they tend to be cost efficient. No credit risk.
What's that mean?
So no credit risk with these options that they're buying. You don't have a backer, as may be the case in like some other structured products out there in the marketplace where you have a backer, oftentimes a bank who is banking and backing that up, or an insurance company who is banking and backing that up with the claims paying ability of that insurance company. With this, because of how most companies, most buffered ETFs, again, I can't blanket statement and say all of them, but many, if not most that we've looked at, don't carry any of the credit risk because there's no bank that has to back it up. There's no insurance company that has to back it up. It's these mostly liquid and available options on the market in the futures. It's just.
So if the provider of the ETF, would happen to go bankrupt or out of business, are you saying that the options that you own with the shares of the ETF are still there?
Yeah. So, people may head for the exits on their particular ETF, and that could drive the price down relative to the NAV. So it may be selling at a discount at that moment. But as far as the targeted outcome, they've still got, however, they kind of built that algorithm trading setup there up front again, it's typically done with options, calls, puts, bonds, zero coupons, et cetera. Each company on each different product may do a little bit different. And it's fun to see because they'll sometimes compete on that. They're like, well, we build our cake with these ingredients and you build it with that. And they could have some merit to them, but having to worry about the ETF company going out of business or issuing bank or insurance company, you don't have to worry about that, which is why they're able to advertise that no credit risk.
Okay. Good.
Why don't you go to the next point on point to point?
Point to point. There is a definite beginning and date on these buffer ETFs that we've talked about so far. So if it's, for example, maybe it's a January ETF that you can, I always recommend make sure you read the information about a buffer ETF before investing in it. But by having point to point, it'll say, here's the outcome period. So our January, for example, buffer ETF, for example, it'll start on January 1st. Here's the parameters around it. And come December 31st, it'll end. It's a 1-year buffer ETF. So you can know exactly what time periods you're working with. Not
too indifferent, or maybe very similar to a bond that is a 1-year bond or a 6-month bond or a 2-year bond.
Yes.
Or an annuity that's a 10-year annuity or a 7-year annuity or whatever term that annuity may be, the 1-year annuity or anything like that, right? You have the known defined risk and return parameters, but you also have this known of how long is that outcome period is. And then we've got transparency, which is a word that people just love. I love transparency. I get frustrated with things in life when I feel like they're not being transparent, especially when I go on to, for example, like websites or stuff in my business. I'll go and look at a new software and there's all this AI stuff everywhere, right? This AI software that does this and this. And I go and look, am I interested in it? And I love it when they say pricing and you click the little bars and it drops down and it shows you your pricing tiers. What I don't like is when I search and there's no pricing, and I'm not going to pursue and find out if it's a good fit for me if it doesn't even say the price, because I know that they're just going to get me on the phone or a Zoom and try to upsell me. Or one place that says pricing, you click on it, and then it scrolls down and tells you the 2 or 3 different tiered plans, but then it says book a meeting for pricing. I'm like, just tell me, be transparent. So from what I've seen, and Dallan, I want you to chime in after I say this, I've seen a lot of transparencies where you can go to the websites and they'll say, here's the outcome period. Here's how many days are left. Here was the initial starting cap gross of fees. Here's the initial starting cap net of their fees, not advisory fees, but net of their ETF fees. And here's the buffer that was initially targeted. And here's the current buffer that's targeted if you bought it today. And here's the fact sheet, and here's the prospectus, right? There's just tremendous, in pricing, there's tremendous transparency that a lot of people like. And again, just in general in life, I like transparency.
You don't like surprises?
Sometimes I like surprises.
Yeah, not in your investments.
If you wanted to buy me a Porsche, I like Porsches. Don't have one.
That would be a surprise if I bought you a Porsche.
That would be a huge surprise.
I would be surprised if I bought you a Porsche.
Okay, so apparently you're going to be making me coffee from the last episode. We haven't found out who's going to win. We need to look that up. And you're also going to buy me a Porsche, and we're going to drive up to Canada to do a podcast.
All right.
Sound good?
Sounds good.
Wait, we better get a convertible because you're tall. You won't fit in the Porsche. Have you ever ridden in one?
I have.
Not comfortably?
No. As a sidebar, the whole midlife crisis where there's a lot of people who go buy a nice sports car, a little sports car. I don't get it. I'd rather have a big old, GMC or Ford F-150.
You buy a boat because there's no roof.
No, I could buy a boat. I can get in and out.
How tall are you? 7 foot? 8 foot?
No, but tall enough and getting old enough that getting in and out of a sports car is not an easy thing all the time.
And if you're watching this podcast, not just listening to it, you'll notice that we had to lower his seat so that we get a little closer to height because he's about a foot taller than me. All right. And go back to the no. I'm just going to make another note on the no credit risk. Before you buy any buffered ETF, check into that ETF and that company and figure out what they have to say about some of these points that tend to be common across a lot of the buffered ETFs in the industry. Look at their literature. For this particular one, we want you to go and visit Calamos, Calamos, calamos.com, and you can learn more about that. So let's go on to the next one. No commission load. What in the world does that mean?
You don't hear a lot of this anymore, but it is true. So a commission load would mean that the price that you pay and then the value of the product you get, it could be lower because the price less what you have in value, that is a commission that goes to a broker or an advisor. This is something where you go, it's back to transparency. Here's the price, and there isn't a different value that you get because there's a commission getting paid. There's no commissions. It's you go buy it. They tell you what their fee is to administer it, but that's it.
Well, even in some products, and I think you said that well, I'm going to say it from a different angle. I think I say the same thing in a different way, is some products, some investments out there, when some people buy them, may have a commission. And that can decrease, they can sometimes take that right out of your investment. So you start with less than what you put in. So for example, if someone had I'm making this up, a 1% commission and they put in $100,000, they'd only have $99,000 working for them. Another scenario is maybe the product just embeds it in how they do the behind the scenes offerings for XYZ. And they put 100,000 in, they still have 100,000, but there was a commission paid to the advisor, consultant, whatever that person may be. But that just gets taken into baked into the equation behind the scenes. Well, the ETF company is not paying blanket statement, buffered ETF that I've seen in the industry doesn't pay a commission. There may be an exception out there now or in the future, but from what I've seen is not. But you can compare that or contrast that with some other products out there where they're not paying the commission, right? You may be paying an advisor a fee, or you may be buying it yourself and not paying the advisor fee. But that's something that needs to be understood here, because a lot of people just think every structured product, every defined outcome, annuity, structured CD, structured blah, blah, blah is going to have some kind of commission. And the fact is, we can just flat out say with most buffered ETFs, there's no commission load.
I think, it's good that it's listed right behind transparency, because I think they're related. Right?
Actually, it's to the right of transparency on this piece of paper. Is that behind to you? Wouldn't behind be over here, or is it to the right?
We talked about it next. How's that?
We'll talk about it on our drive to Canada in the Porsche. I can pull a boat behind the Porsche and you can sit in the boat. We'd get a lot of looks. So I actually had a Porsche when we lived in California. It was an old one. It was like 10 years old at the time. And we'd put my son in the back of the convertible in his little car seat. It was awesome. People would take pictures of us. We felt famous. It was the only time I've ever felt famous. All right. So the next one is easily accessed and liquid. Tell me about it.
So ETFs are traded on exchanges. Is that correct?
Sure.
Yeah. All right.
Yep.
The reason the ETFs are traded on exchanges is that's where the marketplace is for buyers and sellers. They make themselves a lot of regulation and structure around exchanges, but it provides a marketplace for people to be able to come in on a lot of different platforms. They're on a lot of different, I say platforms, Charles Schwab, Fidelity, those type of places where you may buy and sell
there you go.
Stocks and ETFs. They're at the exact same places to where you can go buy and sell them. And they're liquid because they have the same structure as, we keep
typical ETF.
Yeah. So it's no different.
And ETF stands for exchange traded fund. So easily accessed, I would just define as most brokerages where you could buy any stock or ETF will offer these buffered ETFs. And they're liquid, meaning that you can sell them and buy them really at any point in time of the year. You don't have to wait for the beginning of an outcome period. You can buy it intra-period, but again, your risk return, your parameters are going to be different typically than the day that you bought it. So you want to make sure that you know the buffer, what it looks like on the downside, or that buffer, what that protection looks like, and what your potential cap or participation rate or whatever it is may be on the upside. So do your research before you buy any buffered ETF, but in general, easily accessed and liquid. Next one is ability to manage. So I think this falls in the same vein where some people like to trade in and out of these, and they'll look for opportunities. Recently, I remember there was a Bitcoin ETF, and Bitcoin had fallen quite sizably with the market 2 months ago, 6 weeks ago, whatever it was, and it was trading at a very different range where someone could have said, wow, they could have gotten in and had a bigger upside than the original and better downside protection than the original because it had pulled down some on that. And to kind of think about these. So we've talked about on this podcast where you have some volatility, right? So it's not that you eliminate volatility by buying these because they're liquid. You're going to have some volatility. I say this to people about real estate. A lot of people were like, well, my home never moves around in price. I say, well, if your home was listed on exchange and someone could buy it every second of every day, you would see the value of your home fluctuating a lot. How do I know that? Well, you can go and look at these real estate companies, whether it's an apartment complex or commercial real estate or residential real estate or rentals or anything, and you'll see those moving around on a daily basis, getting that volatility. So volatility comes with liquidity, right? Different sizes of volatility depending on the asset, the market environment, and all of that. But the point I'm trying to make is that you have the ability to manage these. You can buy them, you can sell them, you can look for opportunities that may give you a different protection level than you currently have. So you can jump from one to another, or you could get a different upside potential. So you could jump from one to another. If you're in an IRA or if they're offering those in a 401k nowadays, in the future, they probably will, I think. But if you're in that IRA, there's no tax consequences to it. But if you're in like a non-qualified, non-IRA investment and you move from one to another, you're probably going to trigger that taxable event at that point in time, whether that's a gain or a loss, short-term, long-term. So that's one of the things that people will need to take into consideration if they're going to be kind of actively trading in or out of this.
And the only thing I would add to that is, sometime, we've talked earlier about point to point in between time that it could fluctuate, and, we've seen, for example, there's ETFs where you're protected between -5 to 15% on the downside. The ETF may be down, let's say 5%. Well, that may be attractive to some people to say, well, that's already down 5%. So I could buy it here and I'm protected from -5 to 15%, but I have the upside still available that is in that, whatever remaining outcome is in that ETF. There's in between the point to point, there could be opportunities that come up to go ahead and say, hey, that looks attractive to me. So I'll go buy that in between the point to point because there's certain movements that make it attractive.
Yeah. So just like someone may say, oh, they're in S&P related ETF and tomorrow they decide they want to move it all to international. They have the right to do that. It's their money. If they think it's a wise decision from a risk or return, or in their opinion, risk and return standpoint, then they can do it. And the next day, if they want to move it all to a gold ETF, then they can do it. Yeah. It's not dissimilar here. And you did bring up one thing that I wanted to mention, right, is some people will say, well, if something has, I'll take your example, you're exposed on the first 5% down over the outcome period, but you're protected on, say, down 5% to down 30%, for example. And if the market's down 5, they may think, well, I've already got that, so I feel better about that. But with these options, there's a time value component to these options, right? So when they buy these options, there's a time value. They don't just immediately flow right with the market because they're ticking on. I'll use kind of the word ticking off over time, where this will be another episode where we get the ETF provider on here to kind of talk a little bit more in depth than that. But when you have an option, if you bought a 1-year option, for example, just out in the market, and the market went down 5%, you're not going to see it priced exactly where the market is because you've got this component, this erosion, or whether it's positive or negative, that just takes place over time with that option. Right. Be looking for that if you're buying these intra period, because again, there's an option component and that option has time component to it. So keep that in mind if you're looking at these. And then lastly is tax efficiency. So going right along that line. So we just kind of mentioned on that. which is if you buy these intra-period, you have your right to do that. Of course, if it's in an IRA, that should be a non-taxable event to move from one ETF to another, which is just generic how taxes work inside of an IRA for tax deferral or tax-free if it's a Roth IRA. But if it's a taxable account, we typically refer to those as taxable or non-qualified, or people will call them brokerage, different things. If you were up, for example, 4% in that and you'd held it over a 12-month period, let's assume that long-term gains apply, then you'll get the long-term gain taxation on that.
Yep.
If you were down 3%, for example, and you sold it, and let's say you sold it and held it less than 12 months, then you'll probably get the short-term loss for that. But if you just hold them, because you don't have to just get out of it at the end of the outcome period, right?
That's correct.
So you can continue to get tax efficiency.
Yeah. So it's very, very similar to other ETFs where you can hang on to it for as long as you want. It'll roll. I think we talked about rolling into a new outcome period, and the tax isn't triggered. There's no tax triggered until you sell it. So it's unrecognized, and until you sell it and recognize it, there's no tax.
So there's quite a few benefits that are listed right here, but some people still don't like these or don't want to buy them. Again, because we said, there is no perfect investment. We don't make recommendations of what to buy and not to buy. We're not telling you what to do and what not to do. We're just walking through some pros and some cons and some educating you. But some people may look at this and say someone may say, this sounds perfect. I want everything in it. And someone may say, it sounds too good to be true. I'm not going to touch it. So let's kind of hit on both of those and then we'll close out the podcast. So the person who says, what was the first one I said? I think I said, I want to put all my money in it.
I want to put everything. Yeah. That sounds great. I want to put all my money in it.
Yeah. So what might someone on the other side of that say, wait, before you put all your money in it, blank.
So there's I think a good way to go about it is just ask yourself questions or ask the person questions. Okay, let's look at an ETF. Here's your cap on the upside. So let's say on the S&P 500, your cap over a 1 year period is 12%. How will you feel?
It's kind of high. Let's bring it down to 6%.
6%.
Bitcoin,
okay.
Maybe 12%.
Okay, let's say the cap is 6%. How are you going to feel if at the end of the year, the S&P 500 is up 20%? Are you still okay with that?
The FOMO.
Fear of missing out.
Have you ever seen anybody have FOMO?
Absolutely.
Yeah, right. So it's like, oh, I really wish I was in Amazon and bought it when it was, and then we can go back and say, I'm making this up on Amazon, but you can go back and say, it was XYZ stock, Amazon, Microsoft, whatever, was trading at 40 times earnings, 60 times, 100 times earnings at that point. You would have bought it then? They're like, I don't know. But that fear of missing out, right? Once you see something made, you always wish that you'd been in it.
I think it's important to ask yourself those questions, though, at the beginning, so you can kind of make your decision. It's always good to make your decision prior to you having to be faced with it. And so you make that decision, say, yeah, I am okay with that. Okay. Or you can say, no, I don't want all my investments in something like that. I want some exposure to higher upside. Okay. Then we'll start, we'll build your portfolio differently.
Yeah. Great. Diversification could be a reason that some people don't want to, on the other side would say, don't put all your money here potentially. Someone may say fear of missing out, right? If you're going to have that regret, if the market's up big on some or all of your money. That's great. Now, how about the person who says, sounds too good to be true. I'm not going to trust it. I'm not going to do anything. What might someone on the other side of that equation say?
So then it comes down to, what do options do? And so I don't think you need to be an expert in put options, call options, but I think you need to have at least an understanding that options have an expiration, right? And so come that expiration, whatever's going to happen is going to happen. So if it's meant to provide a return, it'll provide that return. If it is to protect your loss, and so the value is zero, the value will be zero. So while it seems hard to maybe get your mind wrapped around how does this happen, to know that there's an option market, and the options, and I'm not talking about it's just a small market. Options, the options that we're talking about here are huge, high volume markets that when they execute, they're going to basically do what they say they're going to do.
Yeah, I was thinking about that, and what I think someone may say on the other side of that equation is say, well, let's talk about what too good to be true is. What if I said, here's an investment, here's something you could put your money in, and you could put in, for example, $1 million, and in a year, they're going to give you your $1 million back plus 5% return, no more, no less. You might say, well, that sounds too good to be true. And then someone might say, well, that's kind of a 1-year bond or a 1-year CD or whatever, right? Based on the claims paying ability of the bank or whatever it may be. But with this, the biggest drawback that some people would say is it's not too good to be true, right? There's a pro and a con to everything in life. This is one of the things, the older I get, the more I understand about everything. I really started to understand that when I went to law school, and that there is a cap or some kind of limit on the upside. Anytime you're going to reduce your risk, I wouldn't say anytime, any of the buffered ETFs that I've seen, when you reduce risk in some way, you're almost always going to have some trade-off where you don't get all of the upside, whether that's a cap or uncapped, but with a participation or with targeted participation, whatever that may look like. So that not getting the entire upside is what it is. And some people are going to say, I don't like that. Some people are going to say, I like that. But that's for each of them to go and explore on their own, to go and look at these companies, to go look at the variety out there, to go talk to their advisor, or to call us and have a conversation with us. All right. So we've talked about some of the benefits of delivering defined outcomes in an ETF wrapper. We used a Innovator piece on that. Companies are going to have these pieces where you'll see some of what they think the benefits of buffered ETFs or their buffered ETFs or defined outcome ETFs or targeted outcome or whatever their names are. But again, we're not making recommendations. We just want to help educate you, get a better feel for the market. And any last parting words?
No, I think we've covered a lot of ground there. Good.
All right. Let's go get a coffee, buy a Porsche, put the top down, and a boat.
That's you're buying.
I'll buy the boat, you buy the Porsche. Well, I don't know. Boats are expensive now. Anyways, have an incredible and blessed day.
All right. Take care, everybody.
We hope you enjoyed this episode of the Buffered ETF Guys. Please hit that subscribe button so you never miss an episode, and share this podcast with someone who could benefit from it. Check out our blogs, webinars, and other resources at atxfinancialplanning.com. You can easily book a meeting with an advisor at ATX Financial Planning at atxfinancialplanning.com. That's atxfinancialplanning.com. We're headquartered in Austin, but we serve clients from coast to coast. Be on the lookout for our next episode. Stay wealthy by protecting your wealth. All content is for information purposes only and should not be relied upon as individual advice. Investing always involves risk and possible loss of capital. All opinions expressed herein are solely the opinions of the person making them. Participants and clients of ATX Financial Planning and guests of this podcast may maintain positions in the securities discussed in this podcast. Talk to your advisor before acting on anything. Nothing mentioned on this podcast, including specific investments mentioned, should be taken as a recommendation. Advisory services are offered through ATX Financial Planning, LLC, an SEC-registered investment advisor.